Welcome to the Virtual CPA Success Show, where we're 100% focused on helping service-based businesses achieve success. Are you a business owner interested in learning how to scale your business? Has your business reached over $1 million in annual revenue? Then this podcast is for you.
Welcome to episode 5. I'm your host, Jamie Nau, and today I'm joined by Jody Grunden, and we're going to dig into our next KPI, effective rate. So just before we get started, I want to let everybody know effective rate has some formulas and definitions behind it. So we will have some notes in the show notes that will talk about how these formulas work in case you want those as a guide as you're listening to this. But we will try to stay out of the formulas in too much detail and really talk about what the levers are in affecting these formulas. So welcome to the show, Jody.
Yeah, thanks, Jamie. Appreciate it. Definitely got that right. Effective rate is going to be it's a complicated formula. It's really simple, actually. Kind of diving into it a little bit. Effective rate is your biggest rate of determination for any service-based company. And so what it's going to be the rate, the all-in rate. So we'll talk about a lot of different rates throughout, and there may be many different definitions from many different accounting sources. And so we want to define what we call effective rate, what we call standard rate, what we call average bill rate, and some of the different things as we go through. So it's going to be really important that we make that distinction, as we're going through the presentation. Jamie, would you agree?
I agree. Yeah, we'll definitely go into them a little bit, talk about how they work, but the actual numbers behind it, we'll have the handout that will really explain that in detail. So effective rate is a production metric, Jody, and that's what we call it on our side when we talk through it with companies. Can you explain a little bit why it's a production metric and how a production metric differs from the other metrics?
Yeah, sure. There's 4 metrics that we talk about a lot. One's cash. The cash metric. One is net income metric, so percentage of net income. One is your pipeline metric, determining, hey, how much do you have in your pipeline versus capacity. And then the production metrics, kind of like the metric you actually determine your forecast with. So what we're trying to do with the production metric is we're trying to determine the capacity of each of your individuals that you have on your team, your production people. So that's why we call it production. It's on the top part of your financial statement. You have your revenue minus production or cost of sales. And that gets your cost of sales, which then calculates your gross profit. So the production metric is going to be really important. For a service-based company, you want that production metric typically to be right at about 50%, is what we find with most service-based companies in the digital space especially. So 50% is the big all-in thing. And as we go through and define how we come up with that production number, we'll go ahead and kind of define, kind of really where that should all reside regarding the financial statements.
Great. And so the great thing about being a service-based company is when you think about production metrics, it's in the word there. So it's about your producers. So how effective are your producers performing? I mean, I think that's another way to say it as well. But I think the way you described it is perfectly. It ties to the income statement. It ties to your gross profit. And you want to see what is the driver. And for service-based companies, we really feel like the driver is your people or your producers. How much are they producing? And so definitely a very important thing to understand there is when you're looking at this metric and how it's performing, it's telling you how your production team is performing or how the gross profit's performing.
Yeah. And I would say a lot of times when you're looking at different stats and different type of ratios, a lot of times you get kind of caught in the weeds. You don't really understand what the ratio typically means. And so with the production metrics, we're going to break down the non-financial metrics. And the non-financial metrics are the drivers for your forecast. And so that's the biggest thing, or this is like the biggest metric really of all. This is the effective rate. And that's the big rate on the production metric that we're going to talk about and kind of show you how to get to it and the importance of it. Should we just go and dive in, Jamie? Or?
Yeah, let's dive in. So just let's go through a couple of the formulas that are going to help us make sense of this effective rate formula. So there's a couple that go into it. And so if you want to start with utilization, again, just tell us what the formula is, but more importantly, tell us how to define utilization and what it means.
Yeah, so basically what utilization is just simply the number of hours that you're working divided by the number of hours that you're getting paid to work. And so that's what basically utilization is. So if you're looking at utilization of one of your team members, you're looking about, how productive are those team members? How many hours during the year? What is that percentage that they're actually able to work? So for instance, if you're looking at an individual that has a regular work week, a regular work year, they're employed all year long. They work 40 hours a week, 52 weeks in a year. You multiply the two, you come up with 2,080 hours. So that's your denominator part of it. And then you look and see, well, how many hours can they typically work? So you're taking out all the holidays, the PTO, the admin time, vacations. You're taking about if you send them on an educational event, typically times they can't work. You have to subtract that out of that number. And then once you come up with the actual number that you can actually bill for, you're dividing that into the total number of hours available, and that's their utilization. So basically what that's doing is that's saying, hey, with one person, what do I expect that person to bill for a period of a year, a period of a month, period of a week, that type of thing.
So if you look at it on a year, that would give you a good estimate of what your utilization is. But to the point you just said, a utilization in 1 week of 75% could be really good. And utilization another week could be 50%, could be really good if you had some holidays happening during that time. Am I understanding that correctly?
Yeah, that's really important to understand too, because when we talk about utilization, a lot of times you'll say, well, hey, I'm going to have a 60% utilization. That's an all-in utilization, including all the PTO time and stuff. And so if you're looking at that on a month by month basis, you're probably always going to be wrong. So you're going to be disappointed in some months and you're going to be really ecstatic in others. And the reason being is because utilization varies drastically from month to month, because in certain months you've got more holidays or more vacation time than you'll have in other months. Typically we see November, December, employees have low utilization because they're taking time off, and they have high utilization maybe in the summer where they're not taking as much time off, where they're really putting in the hours, that type of thing. So it's important to understand utilization overall for a period of time, but it's also important to understand that that's going to fluctuate from month to month. So it's important to understand what that utilization is for each of those months. So when you're looking at it, you're saying, hey, we're supposed to have a 70% utilization this month. Overall for the year is going to be 60%, but 70% is what we're going to hit. And oh, by the way, we hit 80%, high five. Or if we hit 60% in a month, we're supposed to have 70%. Well, then that's not a high five. That's like oh no, what happened? Do we need to reevaluate things? So it's important to understand that on a month-to-month basis where everything falls.
I think the important thing you said there is having that expectation. So I think that a lot of people when they're focusing on KPIs, they focus on the results. What did the number tell me this month? But having the expectation for the month is super important. And that's for all the metrics we'll talk about in any podcast, cash or net income. It's really important to understand what the expectation is to know how you did. So that's a really important point there. So let's dive into the standard rate. So again, this is the standard rate for how much we're billing. But if you want to go into the calculation there, and then also the details behind it, the definition.
Yeah, sure. So standard rate is just your typical rate that you're going to invoice on. It's what you're going to figure your quotes on. So for instance, if you're looking at billing out at $200 per hour, that's your standard rate. And so if you're looking to do a flat fee bill and you back into it, and let's say it's $5 million job or $500,000 job or $5,000 job, you're backing into the number of hours worked. That's your standard rate. So your standard rate is always going to be what's on the quote. That's completely different than what we call the average bill rate. If you're doing forecasting based on a standard rate, you're going to be disappointed all the time because you'll never hit it. The average bill rate's what you actually earn. So that's just simply taking the revenue divided by the number of hours worked. Pretty simple. You can do that by the job. You can do that by the employee. You can do that really by the overall company for the year to find out what your average bill rate is. So the difference between the standard bill rate and average bill rate, two huge differences there. And so again, if the standard bill rate is 200 and your average bill rate falls at about 175, when you do your forecasting and everything, you're going to do your forecasting based on that 175, which again is that average bill rate.
So Jody, I'm a cost plus company here. So my average bill rate, my standard bill rate will always be the same, right? That's the question we get all the time. They'll always be exactly the same. Is that correct? Or is there ways that if I'm a cost plus company that I won't be always invoicing hours?
Oh, well, yeah. If you're perfectly at invoicing every single hour that you work and your team, doesn't lie to you at all and they put down everything, then yeah, you're truly going to be exactly right on. The problem is that never happens. So when you're billing hourly, there's always going to be times that, hey, I feel like, maybe hey, I don't feel like you did a great job on that, so I'm not going to bill them as many hours as I thought I was going to bill, or going to bill less on that. Or you'll get pushback at the high end. You're billing at, 2,000 hours and, the stakeholder on the other side is like, hey, slow down a little bit. Well, you still got to get the job done. And so you'll start eating time. And so it's very common that standard rate and average bill rate very rarely are going to equal each other. I mean, it's a rare circumstance that it does, and a rare company that has, that truly does happen.
Yep. No, I definitely agree. I think it's when we do onboarding with clients, a lot of times people will say, I'm a T&M client, I'm never going to have any write-ups, because that's the other term. That's the difference between the standard rate and the average bill rate, is those write-downs, the hours you're not getting paid for. And that happens quite frequently. People will come to us and say, oh, I won't have any of those. And then 3 months in, we'll have a conversation with them about some project that they aren't billing hours on. Like, well, we talked about write-downs 3 months ago. That's exactly what just happened. So very common.
And Jamie made a good distinction. Write-downs, that's not bad debt. He's not talking about bad debt write-downs. He's talking about what you can't truly bill for. And so he's saying, hey, if you're going to bill, if you have 100 hours planned in that project and you go over, 110, you can't bill for it, you're writing down that 10 hours. That's what he's talking about there. And what we typically see is when clients will come to us, or we'll see, we're talking to people out in different conferences, and they're like, yeah, I'm just not profitable. A 5% profitability. And we always tell people, yeah, you need to be at least 15%, 25% is what you're striving for as a service-based company. Anything more than that, you're doing phenomenally great, high five, but you have to at least be 10%. And they'll come just say, hey, I'm at 5%, but my standard rate's this, my utilization's this, and they're kind of going through all their numbers. And where they typically see that they fall down is that there's such a huge gap between that standard rate and the average rate. They write so much off, and I don't know if it's a self-conscious thing, or if it's just a time management thing, or project management thing, or quoting thing. There's a lot of different reasons for it. But anytime that we see that there's a greater than 10% gap in there, that's a significant issue that needs to be addressed like right away, because we're giving time away. And that's where we typically see companies fail, is that gap between the standard bill rate and the average bill rate. It's typically not utilization. It's typically right there. And it's very common for us to see clients or, prospects that will come in and say, yeah, we find out it's like 30% difference, or 25% or 40%, or, there's huge numbers there. But you don't want it to be greater than 10%. 10% is fair. I mean, it would be great if it's 5%. It'd be great if it's 0. But 10%, we can live with 10%. But 20 or 30% can't live with that on a long-term basis.
It's really important to put a dollar amount with that too. I think, again, the percentage is great, but I think oftentimes when you put a dollar amount associated with that, you can tell people, hey, if you would have billed every hour you worked, you would have had an additional $200,000 this year. And then you just throw that right down to the bottom line and say, hey, that 5% profit just turned into a 20% profit if you're billing everything you work. And I think a lot of people see that and like, oh, okay, that makes more sense, other than just like, oh, that's just an hour we didn't bill this week. So
yeah. So a lot of times what we see is, we will, on some of our clients, put that right on the front of the financial statement so they see it. If it's not on the front of the financial statement, it'll be in one of the KPIs they're looking at, so they can kind of see it there too. So it's going to be one or the other where they can visibly see that dollar amount. Because you're right, when you see that dollar, it makes a lot of sense. But don't you ever get thing to push back? Well, I would never would have sold that anyways, or I never would have done that anyways. Yeah. Sometimes you get that, right?
And also, a lot of times you'll do it for a reason, right? Like you'll go into a job, like we just want to get a job with client A. So we're willing to go in at a lower rate or at and eat some hours, because we know that client's going to lead to a lot more work. So there definitely is some strategic write downs that you're going to take. So you do get that conversation. But the important thing is having that conversation and understanding that write down and what makes it up.
Yeah, and even conveying that to the team. So again, the leadership is seeing that, and that's one thing. But having the project managers see the same thing, that's a different thing.
Yep.
When they see that you're writing down $100,000 on a project or $25,000 on a project, that's real money. And they start really kind of seeing the importance of making sure that everything is done timely. And just because you hit that number doesn't necessarily mean you got that extra $25,000. It doesn't mean you got an extra $100,000. But what it does mean, it means you got more capacity to do additional work. And that's the key thing. And that's what we're striving for. That's why I want that write down to be small.
Definitely. Okay, so the last metric, and the one that this is all about, is the effective rate. So if you want to give us the definition of that and also the formulas.
Yeah, sure. The effective rate is just simply the total revenue divided by the number of hours paid. So again, we get back to that 2,080 hours we paid an individual for. We look at what kind of revenue did that person bill. And so you take the dollar revenue, and you take the number of hours billed into each other, and you come up with an effective rate. So that's the definition of effective rate. Another way of looking at effective rate is just simply taking your average bill rate, which we determine, again, revenue divided by hours billed, times your utilization. And so you've got two ways of calculating the exact same number. And Jamie, the difference is what?
Yeah. So the great thing is the first one, like Jody said, that's the definition. So if I look at the formula as being my total revenue divided by my total hours, that's telling me how much revenue am I getting for every hour worked, which tells me a lot. And that's definitely very helpful, especially when I'm looking at cost. If I know how much I'm paying each employee per hour, I know how much revenue I'm making per hour, it's going to help me determine how productive I'm being. So that's kind of the definition formula. The other formula helps me, how do I fix it? Right. So if my average bill rate is low and I'm taking that times a high utilization, it's going to give me an effective rate of some number. And I can go back at that and say, well, if I just increase my average bill rate by $10, that'll increase my effective rate by $5 or $6, depending on what utilization is. So it helps me figure out how I can fix a problem. And that's a really important part of the definition.
For sure.
Yeah. So that, again, that's kind of why we walked through how they're all related. So it's really important. You have to understand utilization and average bill rate in order to understand effective rate and how to fix it. Let's go into that a little bit now. So if I set an expectation of utilization for a month, Jody, and I don't hit it, what are some things I may have done wrong and how can I possibly fix that in the next month?
Yeah. So again, it's really, really important to understand, again, how to calculate it. And it's really important to also understand that what that month's utilization rate should be. Again, every month's going to be completely different. And so when you're doing your calculation and you do your forecast, you're forecasting based on capacity. So you should be able to tell exactly how much utilization every single month that your team should be able to perform. And then when it actually does happen and you're off, like Jamie's saying, maybe you're under or over, then you're looking for different things that, hey, what are the one-offs? The one-offs could be that we have more vacation than that time that we were actually planning on, because maybe we're planning vacation spreading equally throughout the year. And it just happened that everybody took vacation in April. When we're looking in April, that could be a reason. If that's the case, then great, good to know. Now we need to adjust the rest of the months to make sure that we pull the vacation out of those other months so that we make modifications at utilization going forward. It could be that we just didn't have really anything for the team to do, so they went home or they didn't work. Something like that could always be the case. And if that's the case, then that's a bigger problem, right? That's like, okay, now we got to figure out how to keep our team busy. Maybe we have too many people. So there's a lot of different things that we're going to look at with that. But the idea is not to whip people into shape or to lambast people or make them, get them into order. The idea is, hey, we want to be able to forecast effectively. So we want to know, hey, if we miss this, do we miss this for a reason? And, are our expectations too high? Do we need to adjust our forecast going forward based on that? Or, is there something more internal that we need to fix?
Yeah, I think that's a great point there, Jody. I think a lot of people think of utilization as an individual problem. If my hours are low, my utilization is low, what am I doing wrong at Summit? But it's actually not. And most times it's not an individual problem. A lot of times there's just not enough work, or there's not enough. I took some PTO that month, and it's stuff that we need to look at as an organization as a whole in our forecasting and making sure we're getting that right. Mm-hmm. Okay. So then on the flip side, we've talked about this a little bit, but if my average bill rate was low, other than write-downs, what are the other things that could possibly cause my average bill rate to be a little bit lower in a month that I should be working on if it was lower than expected?
If the average bill rate was low, typically that maybe utilization was really high. So there's usually an inverse relationship there. And so it could be that your team isn't putting all the time to the job that they should be. Maybe they're being bonused or incentivized based on how profitable their projects are. So one way would be I'm not going to build time to that project. I'm going to have more admin time. So you have to make sure that you're incentivizing your people correctly. That's a big thing, and watching the different levers that you're actually pulling. So if your average bill rate is not in line, then you've got to kind of look and see, what might be the reason. Are we putting way too much time in projects? Maybe the business development's not communicating with the project manager, and so they're quoting jobs that the project management team say, hey, there's no way we can get these jobs done in that time frame. So that may be an issue. Maybe there's a communication gap. Maybe it's more of a, hey, the project manager is not managing the team well enough, and so the team is giving time away. There's a lot of different reasons why that the average bill rate can be, lower than what expected. So you have to kind of dig in and figure out what the root cause of the problem is. And again, you're doing it so that as a training method, so hey, if it's something that we can educate our team on, maybe you're looking at it based on the people, and you find out that every job that Sally's on, it's lower than, and then all Karen's jobs are a lot higher. Well, then you have to look at each one of them and say, hey, is this a consistent thing? is all Sally's jobs low and all Karen's jobs high? And if that's the case, what's Karen doing right and Sally's doing wrong? Is she using all the tools that she should be using? Is she using the processes that we've got in place? Is there something that we can educate or train her up so she can bring her average bill rate up? Or maybe she just works slower than Karen, that type of thing. And so it's important to understand and know those things going in so that when we're giving, jobs that are, maybe that need to be turned around quickly, we don't give it to, Sally, we give it to Karen because Karen's much faster. So we have to kind of be able to understand our people and understand what their average bill rates are on a consistent basis. So it's really important to dig it in on the jobs as you're going through. It's also important to dig it, take a look at that on the people that are actually working on those jobs that, again, you can look for those, I guess, obvious educational points where you can kind of, really teach them, what they're doing right and what they're doing wrong and kind of, really build the team that way.
I think that's the great thing about a lot of these metrics is you always get the high level look. So we've talked about how to calculate average bill rate for the company, how to calculate utilization for the company. And that gives me where to look. That's kind of my map telling me where I need to look. And so then I look at the jobs, then I look at the people, then I look at the teams, and you can kind of analyze it at all those different levels to really tell you the story. So to Jody's point, maybe it's just this one job that's really killing us. And we're working we've already billed $200,000 on it, but we've worked more than that already. And every hour we work on that job doesn't count anymore because we're just keep billing on it. And so I think that's the thing that you'll see is that the more detail you look at the stuff, the more answers it'll give you. And I think that's a very key point there.
Yeah, and the other thing would be is the more that you can actually make those corrective decisions. If you're looking at it on a regular basis, not just at month end or not just at quarter end or year end, that type of thing, but you're looking at it on a job by job basis, throughout the job, you can make those corrective actions during the project. If you've got a 2-month project and you see it's going overboard, well then maybe there's something right they're not billing for, or maybe there's something they're doing, they're not doing the right way or doing a different direction that you had actually assume that they're going to do when you actually quoted the job out. So there's a lot of different things. If you're doing it as you go, you can make those corrective actions and, and it'll save you tons of money, obviously in the long run, because you can make those actions now, which, when the job's done, it's too late to make those corrections. It's too late to go back and ask for more money if that's the case, or it's too late to improve on a process that, you've already completed the job. So I would recommend doing them as you go. Don't wait at the end, and use them again as an education tool.
Yeah, no, I definitely agree. I think it's something you learn early on, very early on when you're in a service-based company. Don't procrastinate talking problems with the client. If you have a problem with the client and there's something going on, whether it's they're doing stuff out of scope or things are taking longer than you think, if you go to them when it first happens, it's a lot easier to get either more money or change the scope on other parts of the project. If you wait till the very end, they're going to look at you and be like, sorry, this project's over. There's nothing we can do about it. So I think that's something you learn very early in your life as a service-based employee.
Oh, for sure.
So Jody, any success stories? I know you work with a lot of clients. Any success stories where you feel like you've done a nice job improving effective rate? And obviously that helps the bottom line, but any success stories you can tell?
Yeah, I'd say probably the coolest one, that I had was when we had a business owner that wanted to build a building. I tell this in a lot of different events I go to. They wanted to build a building, but they didn't want to take a loan out. And so it was one of those deals that we had to determine, okay, what was the right size of the building, all that kind of stuff. And he decided it was going to be a $400,000 building is what he wanted to build. And then it was like, well, how fast do you want to get this? How much, how long is it going to take for you to actually save enough money to build this building without having a loan? And so we went through the utilization, we went through the effective rate, went through all the numbers there, and we determined it's going to take about 4 years. And it was one of those things that he just kind of sat back and he's like, 4 years. He goes, I was hoping to have this building done within about 1.5 years, 2 years. And I'm like, well, it can be done. Let's see if we can do it. And so we started playing with the numbers. And so again, we're on this elaborate Excel spreadsheet, playing with the numbers, and we changed utilization a little bit. We changed the average bill rate a little bit. We didn't change the standard price. He didn't want to increase his pricing at all, but he did want to get better between the average bill rate. He was about 20%. We wanted to get him closer to that 10%. 10%, mark. We wanted utilization. He's like, well, my team typically works about 32 hours a week. If I give them an incentive, maybe they'll be interested. Maybe I can get them to work 34 hours a week. And he did. He's like, yeah, they thought it was a great idea. Gave him an incentive, kind of built the building project into a goal for this team there. So they had an incentive there. And then, we basically just kind of, played with the numbers a little bit until we came up and we reduced it from 4 years to about 1.5 years. And so it was about 18 months. And so then it was like, okay, great. We've got the map drawn out. We've got we've got the goal here. Now you have the work to do it. And so it was like, I've got the work. I can get the work. And so now his goal was to really focus on the business development side, really focus on getting, his closing ratios down, getting all the different ratios that go into the sales side. And he was able to build a huge pipeline for it. And he did. He succeeded with his goal within a year, about a year and a half. He built a $400,000 building, paid in cash, and did not take a loan out, which was the coolest. It was cool. It was really cool to basically see that, because he went into the job with no idea how to do it, and just by kind of working through the map, we figured it out. And it's kind of funny because people do that all the time. It's like, if they don't have that, that guide or the map, they kind of wander around and they're like, well, how did I get here? Why wasn't I profitable? Or how come I was so profitable? Where's my cash? All those different things that, you just don't know, because, you didn't go to, Kelley Business School to Indiana University to figure out how to do all this. Right. And so it's one of those things that, it's kind of inherent for us that we can help, people to get to where they want to get, to help develop that roadmap. We can't do the work for them, but we can kind of give them that guide. And that's the cool thing about it, was because it was one of those things that I felt just kind of as cool as what he felt. It was like, even though I didn't have a building, it was like, this was cool. We actually succeeded, put the roadmap together, and succeeded on getting it. Because again, once you have that plan in place, it's kind of funny how people just gravitate towards it. And the funny thing was that, if it would have taken 2 years to do it, that'd have been cool too, right? It took us a year and a half. It wasn't 4 years originally, and may never been never, had we not put the roadmap together to begin with. But we did, and we were able to accomplish that goal.
Yeah, I think what you said there, and I think it's great, is measurement and consistency is huge, right? So measuring something and then consistently looking at it really helps you understand exactly how you're doing. And I think that's what a lot of times when we first start working with people or start talking to people is they don't really know how well they're doing. Like, they know how much money they have and they might know what their net income is, but they don't know really how they're getting there. And so just to show every month to them, this is your effective rate this month. It was low. What happened? And just having those discussions is a lot of times the most value you can get from having just someone to talk to about it. So I definitely agree. Just knowing where that number needs to be, what it needs to be in order to hit your goals, just really does tell a great story. So Jody, any final points on effective rate that we didn't get across? We're getting close on time here.
Yeah, no, I think the key is knowing what your effective rate is. That's the important thing. So go through the calculation, figure it out. I think we're attaching a guide to the thing. We'll kind of go which goes through some of the formulas. Take a stab at it. Figure out what each of your employees can do. Figure out what your team should be able to do. What your company's actually built to do based on the number of producers you have in there. Once you have that number, then you'll know what that total revenue number is. Then you'll know what your total effective rate should be. And the key there is that everybody's effective rate is going to differ. So if you ask me what my effective rate was compared to your effective rate compared to somebody else's, they're all going to differ, because it's going to be really based on your effective costs, meaning how much do you actually pay your employees, which is a completely different formula altogether. But the key there is to know that, hey, when you're looking at it, just because you have 100 effective rate and I've got an 80, there's no difference there. I could be more profitable than you with that. So the important thing is just know what your effective rate is, not what everybody else is, but yours is, and then how yours. And then once you know what that is, then you can actually forecast going forward. And that's really the key, using the effective rate for forecasting.
Yep. And we'll definitely spend a podcast talking about that. I think that's a really important topic that we can dig into a little bit further, is how to lay that out, go through the details of how that works. And again, today we've kind of talked about the measurement of it, but I do think setting an extra podcast on actually the details of forecasting will be really important, and that will be a big part of it. So
for sure.
So I appreciate taking the time today, Jody, and I think we covered a lot here, and I think that's a wrap.
Sounds great.
Enjoy this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving virtual CPA success. We're here to be a resource in this ever-changing industry.